How rich people make money with debt. In recent years, the word debt has developed something of a bad name. But the truth is that not all debt is bad. In fact, some types of debt can do you a power of good. Going further than that, good debt is one of the best ways to start leveraging the power of your money and creating passive income streams that help you develop real wealth. In this video, we will talk about how rich people make money with debt. But before we begin, please like and subscribe to our YouTube channel for such amazing and informative videos. 10. Debt consolidation. Debt consolidation refers to taking out a new loan or credit card to pay off other existing loans or credit cards. By combining multiple debts into a single, larger loan, you may also be able to obtain more favorable payoff terms, such as a lower interest rate, lower monthly payments, or both. You can roll old debt into new debt in several different ways, such as by taking out a new personal loan, a new credit card with a high enough credit limit, or a home equity loan. Then, you pay off your smaller loans with the new one. If you are using a new credit card to consolidate other credit card debt, for example, you can transfer the balances on your old cards to your new one. Some balance transfer credit cards even offer incentives, such as a 0% interest rate on your balance for a period of time. In addition to the possibility of lower interest rates and smaller monthly payments, debt consolidation can be a way to simplify your financial life, with fewer bills to pay each month and fewer due dates to worry about. 9. Making your savings work harder. Many people like to keep money in a cash savings bank account as emergency funds or a buffer, making them feel more secure. The fact is that this money could be more wisely kept in an offset account linked to your mortgage. You will earn a higher after-tax return and reduce the term of your home loan, all without locking up the funds. Making your money work for you essentially means to use your money to make more of it. And while this might sound like a bit of a conundrum, there are a gamut of financial decisions that can help you do this. As dull as it may sound, creating and sticking to a monthly expense plan is key to making your money grow. It not only helps to determine where you are spending your income but also helps you to change the way you manage your money. The ultimate goal is to spend less than you earn and keep track of where unnecessary expenditure is being made. 8. Better cash flow management. Cash flow is a measurement of the amount of cash that comes into and out of your business in a particular period of time. When you have positive cash flow, you have more cash coming into your business than you have leaving it, so you can pay your bills and cover other expenses. When you have negative cash flow, you can't afford to make those payments. The concept of having enough money to meet your financial obligations is also known as working capital. Proper cash flow management is a key strategy that every business owner must master for long-term financial success. Managing cash flow can be one of the biggest challenges business owners face. 7. Borrowing to invest. Borrowing to invest, in property or shares, or gearing, can be a powerful means to build wealth over time, as it enables you to purchase more investments than would be otherwise possible. If your investments increase in value over time, gearing can generate a higher overall return. After the interest and other costs associated with the debt have been factored in, capital growth and income generated from the assets can also be used to pay back the debt plus interest and fees. The interest charged on the debt may also be tax deductible. 6. Debt recycling. Debt recycling can be an effective strategy to accumulate wealth over time by converting some of your debt, which is inefficient, doesn't generate capital growth or income, or isn't tax deductible, into debt that may be efficient, generates capital growth or income, or is tax deductible. One way to do this involves using a lump sum possibly received from a bonus or an inheritance to pay off your inefficient debt. If you then borrow the same amount and invest it, you're essentially replacing the inefficient debt with a debt that is tax deductible and could potentially generate wealth. There are other options for implementing a debt recycling strategy, with varying levels of risk. A financial advisor may be able to help you determine a strategy that is most suitable for your needs. 5. Invest in a geared managed share fund. A managed share fund is internally geared, so that you don't have to take out an investment loan yourself. Yet you can still benefit from the gearing effect of borrowing to invest. Here the fund manager borrows, at wholesale rates, on behalf of investors to invest in international or local share markets. 4. Short selling. Selling short reverses the normal order of buying and then selling stocks. Selling short means to sell something you don't own. When you sell a stock short, you borrow the stock from your broker and sell it to a buyer. You then owe the broker the shares. You receive cash from the sale but have to use it to buy the shares later to pay back your broker for the loan of shares. You are long cash and short the shares on a short side trade. You're in debt for shares using the credit available in your margin account. When you buy to cover the short position, that will be your debit purchase price to buy back the shares. You were short in the open market, then your broker can return the shares to the account they were borrowed from. This is all done electronically today and is computerized and automated. 3. Margin account. A margin account is a type of brokerage account where the stockbroker lends the investor cash or shares, using their account as collateral to purchase securities. Margin trading is when your broker adds buying power to your account to increase the size you can trade and the quantity of trades you can make. Margin can be used to add leverage to your trades or for faster turnover on your trades without having to wait for them to clear after entering and exiting. If margin is used to increase the size of your trades, then your results are amplified. If you trade twice the size of the position you would have traded without margin, then your wins are twice as big, but also if it's a losing trade it would be twice as big of a loss. 2. Leveraged buyout. A leveraged buyout, LBO, happens when the buyer or buyers of a company takes on a large amount of debt as part of the purchase process. The buyer will use assets from the purchased company as collateral to acquire the company with plans to pay off the debt later after the buyout using future cash flow from the company. After a leveraged buyout, the buyer ends up with controlling interest in the target company. 1. Leverage in real estate. Buying real estate allows you to leverage your capital by multiples of 20 with 5% down payments or multiples of 1,000 with monthly payments. For a down payment of $10,000, a real estate investor can own a $200,000 house with a $2,000 monthly payment. Real estate investors make returns on the full amount of the loan, not just the money put into the investment. If the piece of real estate goes up 20% in value from $200,000 to $240,000, then the $10,000 down payment creates a 300% return with the $40,000 investment return. With all of the above steps, it's important to get quality advice and to understand the risks and the potential returns. Did you learn something new about how rich people make money with debt that you didn't know before? We hope you did. So, if you're interested in learning more amazing knowledge about finance and making money, make sure to subscribe to our YouTube channel and hit the bell icon to get notified by our new videos. Please like and share the video. Don't forget to comment down your views on this. Thanks for watching till the end.